Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Thursday, the 6th of March here in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, Germany's bond rout goes global as Japanese yields hit their highest level in a decade.
French President Emmanuel Macron says he is open to using the country's nuclear deterrent to protect European allies.
Plus, a partial reprieve. Trump delays auto tariffs on Canada and Mexico, as the Bank of England governor warns America's trade war won't fix its trade imbalances.
Let's start with a roundup of our top stories.
Japan's government bond yields have reached their highest levels in more than a decade as a rout in German debt reverberates across the globe. The news also led to a surge in yields in Australia and New Zealand. Markets are continuing to react to a dramatic shift in Germany's spending plans that saw the country's bonds suffer their worst day since the fall of the Berlin Wall in 1989. Bloomberg's markets live strategist Mark Cranfield says the impact of those moves should be seen in that context.
This is a sea change. This is a watershed moment for Europe, for the euro, for everything to do with monetary policy. It's a very different situation than just a few weeks ago.
The moves show how geopolitical volatility over the past few weeks, including fraying US support for Ukraine and evolving tariff threats, has affected financial markets as traders gauge the impact on growth and inflation.
Well, the rout in global bond markets comes as the European Central Bank is expected to cut interest rates later today. But markets are already paring wagers on further rate cuts by the ECB. Expectations are building around the scale of borrowing required to finance spending plans to counter the threat of Russian aggression across the continent. Here's the view of Bob Michael, who is the Chief Investment Officer and Head of Global Fixed Income at JP Morgan.
I think you're looking at steeper curves in Europe. I think you're going to see a lot of issuance. They've thrown fiscal austerity to the side. They've looked at what's going on in China and the U.S., and they want to join the party, and they're going to. I still see the ECB bringing rates down towards 2%, but I think with the amount of supply that's potentially coming in Germany, you're going to drift up towards 3%.
Bob Michael speaking there as analysts and investors focus on whether the ECB continues to describe policy as restrictive.
As markets readjust to the cost of rearming in Europe, France's President Emmanuel Macron says he'll start talks on using the country's nuclear capabilities to defend allies on the continent. Macron's decision follows a request from the German Chancellor-in-Waiting, Friedrich Merz, and comes ahead of an emergency EU leaders summit to discuss the Ukraine and European security later today. Here's what the French president said in his televised address to the nation.
Our nuclear deterrent protects us. It is complete, sovereign, and French, through and through. Since 1964, it has explicitly played a role in preserving peace and security in Europe. But, in response to the historic appeal of the future German Chancellor, I have decided to open the strategic debate on the protection afforded by our deterrent to our allies on the European continent. Whatever happens, the decision has always been and will remain in the hands of the President of the Republic, head of the armed forces.
French President Emmanuel Macron there. Thursday's EU summit is expected to endorse a loosening of the fiscal rules to allow for additional defence spending over the next 4 years. The gathering comes as it was revealed the US has stopped providing most intelligence to Ukraine. It's the latest evidence of Washington ratcheting up its pressure campaign on Kyiv following the decision to pause military aid to the country.
US President Donald Trump is giving car makers an exemption from new tariffs on Mexico and Canada, but only for 1 month. Bloomberg has learnt that automakers lobbied heavily for the reprieve, calling Commerce Department officials, Trump himself, and even involving their workers' unions to give them leverage. White House Press Secretary Caroline Leavitt announced the change.
We spoke with the big three auto dealers. We are going to give a 1-month exemption on any autos coming through USMCA. Reciprocal tariffs will still go into effect on April 2nd, but at the request of the companies associated with USMCA, the president is giving them an exemption for 1 month so they are not at an economic disadvantage.
Shares in Stellantis, GM and Ford jumped after Levitt's announcement, but the delay sets up another crossroads next month when Trump is planning a new wave of tariffs, including on auto imports specifically.
The risk of a recession is growing as tariff-related uncertainty and indicators of economic weakness spread fear across Wall Street. Separate models from JP Morgan and Goldman Sachs both saw the chance of a downturn 10% higher than at the end of last year. Concerned economists like former Treasury Secretary Larry Summers point to stubborn inflation pressures and the recent slump in consumer and business confidence.
If you were thinking about buying a new car or buying a new house, wouldn't you wait? And when everybody waits, the economy slows down, and that's why the risk of recession, which everybody thought was extremely unlikely on January 20th, is now seen by many, many people as a real and serious risk for some time this year. So I think we're doing real damage.
Summers compared the US president calling tariffs a small disturbance to the Fed calling inflation transitory. However, financial markets have struggled to guess the direction of the economy since the pandemic.
The governor of the Bank of England says the US trade war is a risk to the global economy. Despite the UK so far escaping any tariffs, Andrew Bailey warned Britain will face consequences. He told lawmakers the change in US policy was a major shift.
We have to dig in at this point and say, how do we address these issues satisfactorily? We can't ignore them, frankly, at that point, because otherwise the risks to the UK situation, to UK growth, the impact on inflation could be ambiguous, but the risks to the UK economy and to indeed the world economy are substantial.
Andrew Bailey and the other central bankers testifying said that the uncertainty meant policy would need to remain restrictive. The pound jumped to its highest level in 4 months on the comments.
Those are your top stories on the markets. We're watching the bond sell-off going global after the worst rout in German bunds since reunification. The 10-year yield in Japan now at 1.51%, up 7 basis points. A big move in context for JGBs. We're looking at German bund futures extending those declines, pointing to another 5 basis point rise in yields at the open. We also see a big move in equity markets. Yesterday, the S&P 500 finished up 1.1%. The Nasdaq finished up 1.4%. The DAX in Germany finishing up by 3.4%, its best day in over 2 years. The broader Euro Stoxx 50 index up 1.9%. The euro strengthening further today, up another 0.2%, crossing 108 against the dollar. The best 3-day gains for the single currency since 2015. In Asia, we're looking at the Hang Seng up 2.7%. The MSCI China index 3.1% higher. Tech shares performing strongly in Asia. The Hang Seng Tech index is up by 4.7%.
So those are the markets. In a moment, we'll bring you more on how the bond market blowout over Germany's defence spending plans has affected so many markets, and we'll give you some heads up about what may come next. Plus, what we should expect from today's meeting of EU leaders on Ukraine.
Plenty to dig into there. Another story that caught our eye, though, briefly just to mention, from our opinion columnist Stephen Carter, writing about beards. This is after the New York Yankees baseball team lifted their ban on players being allowed to have beards. I didn't realise that was still a thing.
Yes, it is a thing. So there are lots of different views about why they've done it. Basically, is it to allow these sports people to distinguish themselves better, therefore to market themselves and, to kind of give them more freedom to be individuals? That's one take on it, but there are others. Yeah,
I mean, look, I was interested to read into sort of the history of the societal perceptions of beards, which Stephen Carter goes into in this article as well, and saying things like, a 2015 study found that women were less likely to vote for male candidates who had facial hair, for example. Apparently it's still an issue in hiring, is that people are less likely to hire men with beards than men who don't, although there is one research paper highlighted in this piece showing that it can help if you have a job in sales. For whatever reason. I also just wonder as well how different the perceptions are in different parts of the world. I mean, I have never been ahead of a trend on anything, and I've had a beard for 10 years. So.
I was going to say, I'm allowed to reveal to our radio listeners that you are sporting a very attractive beard.
I was on TV at the time, but there was a debate with my boss at the time when I grew a beard as to whether or not it was a good idea. But it's been 10 years.
So facial hair remains controversial. Very interesting. Thank you so much to Bloomberg opinion columnist Stephen Carter then for giving us fodder to chat this morning.
Let's get back to the top story this morning, the sell-off that we saw in German bonds going global. We've talked about the jump in Japanese yields as well. We've got our executive editor for Asia Markets, Paul Dobson, with us for more. Paul, can you just first of all put the moves that we saw in Germany in context for us? A 30 basis point move in one day. We're looking at a 10-year bund yield now almost at 2.8%. How significant is this, and does it look like it could be temporary or lasting?
Good morning, Stephen, Caroline. This is a very significant and large and unusual move that we saw in the bond market. As you said, we haven't seen such a similar size of move in yield terms since the end of the Berlin Wall. Bonds are not supposed to move in a violent way, right? They're supposed to be low volatility investments. People like them because they don't move very far. But the price, for example, of Germany's 30-year bond moved more than 4% lower yesterday, which means that if you're sitting on it, your paper loss is looking pretty big and pretty unusual and hurting you quite a lot. And on the flip side of that, the higher interest rates mean that it's going to cost the German government a lot more to borrow. If you think about the adjustments that you've had over your mortgage rate as the Bank of England or a European Central Bank was raising interest rates in recent years, then that's the kind of thing, but on a much greater magnitude. So it's going to cost Germany a lot more to raise all of this extra money that it wants because investors are anticipating that massive flood of extra supply into the market. Very significant, very nasty one-day move. I think, is it enduring? Yes, absolutely, because we've only got the very basic parameters of what this might look like so far. If you're assuming that it's going to pass in Germany and it looks like, give or take, it ought to be able to go through. It's a paradigmatic shift. It really is, because that lifts a lot of the sort of presumptions that investors had when they took on these bond investments in the first place. So as a result, Germany is going to carry a much higher risk premium than previously. That said, so look at it from the other perspective, Germany's borrowing costs are still lower than pretty much anywhere else, certainly in Europe. So it is still the safest asset, but all of a sudden not quite as safe, and it's all to do with those supply-demand dynamics.
Yeah, the 10-year yield's at 2.79 versus the Japanese yield this morning at 1.51. But that has also seen a major move. How is it playing out in Asia? Why such a big move also in Japanese yields?
Yeah, so Japanese yields have been on an upward trajectory for a while, for so long, decades. They were very, very low, and even negative at some points on the 10-year. But we've seen them slowly inching higher over the last 18 months to 2 years. And the reason for that is that inflation has finally worked its way back into the Japanese system. And that means that the Bank of Japan, ever so cautiously and tentatively, has started to raise interest rates. So when those Japanese investors are looking across the global markets now, they have huge amounts of money to deploy. They like to put a lot of it into Europe, but if all of a sudden their investments in Europe are less certain, or they can get a higher yield for those investments in Europe, maybe, then relatively speaking, maybe they're going to demand a higher yield premium in order to continue to put that money in their home market as well. So corresponding rise in interest rates there as well, which takes us to the highest levels that we've seen in ever so many years. But that's part of an ongoing trend, and it's one of the reasons that the yen has been strengthening over the past few months as well.
And just cycling back then to Europe, Paul, we've got the ECB decision today. We're expecting a move in interest rates lower from the ECB, but will Christine Lagarde face tough questions about what higher bond yields are going to mean for potential fiscal stress in European countries?
I think there'll be an awful lot of questions. It's perfect timing in some ways and terrible timing in others, because there's so much uncertainty out there for the ECB to deal with. People are pretty much convinced that the ECB will cut interest rates today, but they're looking forwards to what the outlook from here looks like. Goldman Sachs removed one of the cuts that it had in its forecast for the rest of the year already. Nomura, I think, took away two. So, the banks are starting to challenge whether the ECB will have the same amount of room to cut interest rates as it would previously. And the reason for that is if the likes of Germany are all raising a lot more money in the markets that they're going to spend, invest, put to work either in defence and in the rest of the economy, then that, all things being equal, should lead to higher growth and it should lead to higher inflation as well. And so that gives the ECB less wiggle room, or maybe less incentive to cut interest rates as fast as it might otherwise have done. So I think there's going to be difficult questions on the rate side for Madame Lagarde and the crew. And like you said, also on fiscal sustainability. If everybody does start spending a lot more, breaking the debt cap that Europe has in place in order, to fund the defence that's needed to protect the borders. How does the ECB react? She said a long time ago, it's not our business to look after spreads. It's not our business to worry about those kinds of things. But if the funding costs start to really spiral and get out of hand, then it may be a difficult conundrum for the ECB.
Paul, thank you for being with us. That is Bloomberg's executive editor for Asia markets, Paul Dobson.
Well, of course, part of the conversation is political around the defence spending as well, and that's going to be continued at an emergency meeting of EU leaders in Brussels later today. This after France's President Emmanuel Macron said he'll enter into talks on using France's nuclear capabilities to defend European allies. Our EMEA News Director Rosalind Matheson is with us for more. Ros, first of all, on what we heard from Emmanuel Macron, are these significant comments? What sort of message was he trying to send with his address to the nation last night?
France is the only country in the EU that does have a nuclear arsenal. So what France is saying is that perhaps they can look at stepping in a way to provide that element of deterrence for the continent. And that's something that the incoming German Chancellor, in fact, Friedrich Merz, has already raised as maybe as everyone in the region is asked to step up. That's one way that France can do it. But obviously that's a delicate one for France and certainly for Macron to navigate domestically. But the idea would be, again, just to provide some kind of regional deterrent in the event that the US no longer wants to do so.
Do you think that we're going to get more announcements of additional military spending, perhaps at today's summit, after Germany's announcement of a major ramp up in military spending?
We may, although Macron didn't give a lot of details, obviously, in his speech last night. And what was interesting in a way is that he noted that any increase in defence spending can't be funded by tax increases. And that just shows that for a lot of countries in the region, they don't have a lot of wiggle room. I mean, Germany probably has the biggest amount of fiscal room there. But for other countries too, the options aren't that great. You either load up on debt, and they're already loaded up on debt, or you increase taxes, or you cut spending. And there's just not a lot of room to cut spending. And already, if you're talking about cutting things, that people find important in their own daily lives, like education, healthcare, social welfare, or so on, you're going to find yourself in difficult straits politically. So that's why it's interesting to see, countries are talking in very general terms right now. We must increase our defence spending. We must do more on defence. But putting actual figures on it can be a bit tricky.
I mean, how difficult is it going to be to get the fiscal get-out clause activated to be able to kind of allow for this spending, I suppose, to do the paperwork that has to come with these ambitions?
Well, some of it can be done without needing every country in the EU to support it and vote for it. So some of those issues around maybe issuing loans, allowing countries to spend more on their own defence without busting the fiscal rules of the EU and so on. But, things like joint financing of debt, joint issuance of debt, which is a really big one. And that's the kind of money that's really needed if they're talking about the kinds of steps up in defence spending that Donald Trump at least would argue Europe needs to do, and that requires everyone in the EU to agree, and that's where it's going to get a lot trickier. So they can come up with some things, and it's clear they're trying to, and those are in the magnitude of hundreds of billions of dollars, obviously. However, the really big stuff requires everyone in the EU, and that's going to be a lot harder.
How far do we think that European leaders can actually make up for the sudden pullback in US support for Ukraine? The concern only increasing because of the recent move to freeze some intelligence going to Ukraine and the impact actually on the battlefield.
Well, that's right. There's a lot of expectation that the US has pulled back on intel sharing, and what does that mean for Ukraine on the ground? And obviously, the intel network does require the US to be part of it. So even if you're Europe is still in there. It's going to be partial intel sharing. And obviously on the weapons side, the US, without the US, Europe's quite limited, because even though they've been a really big provider of aid to Ukraine and all of that, it's important to remember Europe has been sending a ton of weapons and financial aid to Ukraine. They're running low, and they can't make up for the US not sending their own weapons in. And so there's a lot of talk that Ukraine may run very low on weapons as soon as the summer as a result. A lot of the stocks in Europe are also pretty low.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.